Hi everybody. I want you to look at this sentence and tell me what you think. Buy high-cost gold mines to have the highest leverage. Do you think this is correct or not? Are we going to buy high-cost gold mines to gain more leverage to the gold price? That's what everyone says, right? But I think this is completely wrong. This is a wrong assumption. And I will tell you right now why. So let's say we have a gold mine, and you can see here all the parameters. We have the share count, we have the production, we have the capex, all-in costs, pretty high all-in cost. Has some debt, so interest payments, tax rates, and a market cap of 1,000 million, so 1 billion. Okay, so this is our gold mine. What is the leverage? That's this formula. So the leverage is actually lower than 1, even if we have a high cost, because 1,500 AISC is pretty high cost. So if the gold price goes up by 100%, so a double, then the share price should only go up by 65%. That's what this means. 0.65 leverage, right? So if gold goes up from here to here, that's probably around 25%. Then here, the market cap will only go up by less than 25% when you draw this line here, okay? So it's not true that when you buy high-cost gold mines that you will have high leverage. That's not true. There are a lot of parameters to consider. First of all, production. The higher the production, the higher the leverage. So let's say our 100,000 goes to 500,000. Then you see the leverage goes to 3. So that's the first thing you always need to look at. That's production. The second thing that can change the leverage is the valuation of the company. This company here is completely overvalued. When you look at the current gold price at 2000, doesn't earn any money, but it's trading at 1 billion. So this is a completely overvalued company. It's trading at maybe 100 times earnings. Yeah, it's trading at 100 times earnings. So this is completely overvalued. Will not have a lot of leverage. So the valuation of the company will have an effect on leverage. Let's say this market cap is not 1 billion, but half of it. Let's give it a share price of 2. That's half the current share price. What happens? The leverage increases, 1.3. Let's say we half it again to 1. Then the leverage increases, 2.6. So the market cap or the enterprise value, it's better to use enterprise value, never use market cap, use enterprise value, because you need to take into account the debt as well. So let's assume this is the enterprise value. If this goes lower, then the leverage goes up. So let's say we take 0.5. Let's say this company is crashing almost to 0. Then we have a leverage of 5. Okay. So it all depends. It depends on production. It depends on the enterprise value. And you need to calculate this yourself. Don't just assume what the leverage is of a company. You need to calculate the leverage. And here we calculate it as 5 times leverage if the market cap is $125 million. So we have production that can change the leverage. We have market cap that can change the leverage. Now, the third thing that can change the leverage is, of course, the costs. I agree that the cost can be a parameter on leverage. Let's say the leverage, let's say the cost is now 500. So a very low cost production. And typically, when you have a low cost producer, the market cap is, of course, higher. This company is very profitable. You can see that the valuation at 1900 gold is at least 250. So let's put the share price back to, let's say, 3. Yeah, maybe that's too much. Let's say 2. So at 2000 gold, this would be a PE of 10, okay? Because this is PE of 5 and this is PE of 10. So this is a good valuation. We have a leverage of 1.3. So lower leverage because the cost is low. Now, what can we conclude here? There are a lot of parameters to consider: production, costs, and market cap. So which kind of gold mine should we actually buy? Should we buy the high cost ones or the low cost ones? Of course, we always take the low cost ones with low AISC because that's safer. That's much safer. Because if you buy one with AISC of 1,700, then you go bankrupt in a second if gold goes down. So you don't want that. You need to buy the lowest cost gold mine and calculate the leverage. Because if you find a gold mine where the market cap is, for example, only 125, like this, then you have a low cost mine with high leverage. Low cost mine with high leverage. That's possible. In this case, it's possible. You can see here 1900 gold. It's undervalued, an undervalued company. And we have a leverage of 5 with high margin production. Such companies exist, people. You do not always need to buy the high cost mines. Find a low cost mine with high leverage. And you know which one that is. I keep talking about that one. And this is just a video to show you that it's possible. So buy high cost gold mines to have the highest leverage is wrong. you can actually buy a low-cost gold mine with high leverage. And I'll see you in the next video.